We've got a distinguished panel ahead of us. I'd like to introduce them if I can find my notes.
Just find somebody. Yeah.
So I'd like to start off with Fuller from the Government Employees Pension Fund from South Africa. The next I'd like to introduce is Cleopas from the Public Service Pension Fund from Swaziland. And I believe that we've also got Lesidi, the acting CEO of the Botswana Pension Officers Pension Fund. And then finally, Dev, who is the chairman of the Africa Pension Funds Network, but also runs one of the pension schemes, as he will probably talk to us about in Nigeria. Our duty today is really to talk about, first of all, just a brief background about the pension funds, and then our involvement in the capital markets, and then what the opportunities are from the rest of the continent, and also global institutional investors where they can invest with us. So we've got a very good mix, as you can see from the panelists, a lot from Southern Africa. I'll pitch from the east of Africa, and then finally Dev will talk to us about the west of Africa. But hopefully by the time we've all put in our pitch, you will have a view of what's happening within the continent, certainly within the pension sector, and what the opportunities are, certainly, for you to be able to invest. So I'll start off by talking about the Ugandan scheme, which is the NSSF, largely created in the 80s. Actually started off in the 60s, but reformed in the 80s. And the purpose was to try and provide, obviously, retirement benefits to employees within the private sector. However, it was started by a government instrument, which meant that government owns it. However, it is addressing the workers within the private sector. It is a DC scheme, or a defined contribution scheme, and the benefits are paid out in a lump sum. Population of Uganda is about 40 million people, of which 15 are working, and about 10% of those are covered by this particular scheme. So there is quite a lot of people not covered, and those are mostly in the informal sector. So in terms of the governance of the scheme, it's obviously the trustees are chosen from the government, or as part of the government situation, but also from the employer side. So there is the tripartite arrangement where you have government on one side, you've got the labor unions on the other side, and then you've got the employers who've got seats on the board. And our population, like most of Africa, is very young. About 70% is less than 30 years. So our investments tend to be for the long term, because obviously the liabilities are again for the long term. So there is opportunity for having a lot of funds available to be able to invest within the country and also within the East African region. The sector is currently undertaking reforms, and we believe that those reforms will allow a lot of the pension schemes from outside of Uganda to actually come in and participate on the collection side, but also on the investment side. And we believe that that should stimulate especially the informal sector, where there's been a logjam with not being there appropriate benefits for members to join from the informal sector. With regard to our investment, as I said, much of the age of 70% of our members being lower than 30 years means that in terms of our investments tend to be long-term horizon. Our sort of asset allocation is between fixed income, equities, and real estate, with a higher percentage allocated to fixed income, about 75%. Our sort of desired is around 70, so we've got a little bit of a spillover there. Equities, our desired is around 20-21%. We are at about 16-15%, so we need to do a little bit more on there. And certainly on the real estate side, slightly high on there, but mostly of illiquid real estate, and very little in terms of REITs and all those instruments that give us the liquidity. Equities have done very well. Obviously, we've had the discussion from the panel before last, where they talked about the performance of the stock exchanges. In East Africa, we've seen very good performance of the stock exchange, and therefore that has given us very good returns for our members. Our challenge now really is to try and see if we can put a little bit of exposure into private equity and also venture capital with a view to then exiting some of these investments through the stock exchange, basically stimulating the stock exchange to have more product, because that's been one of the issues. And then certainly within the real estate area to try and bring in, especially on the supply side, but also on the demand side, creating instruments there. So what is in there for the institutional investors? I believe that certainly within the whole of East Africa, I think the message was passed on clearly by the presidents yesterday. There is a couple of bond opportunities, especially government bonds, because there's a lot of fundraising for the power projects, the roads, the rail, and the gas and oil, especially on the refinery side. So lots of opportunities there. Obviously, notwithstanding the fact that there's been instability in the exchange rate, largely driven by external factors. Everybody knows about the problems of China and the strength of the United States dollar. So that has had an impact on the currencies. But certainly, foreign investors have been part of the market. We've seen that drying up slightly. And we believe that once the currency stabilizes, and we think that there's been an overvaluation of the currency, we should see some bit of stability, and therefore, foreign investors would be welcome. So just a little bit of an overview from the East African region, which hopefully we can then see either duplicated within the rest of the regions. That's my 2 minutes, and I'd like to ask now Fulu to talk about South Africa. Talk about your strategy and what the fund is doing and what you intend to do, certainly within the investment area within Africa and your own domestic market.
Okay. I don't know if this is on. Can you hear me?
It is on.
Okay. Good morning, and thank you for the invitation to this summit. My name is Fulu Makwetla. I'm from the Government Employees Pension Fund of South Africa. It is the largest pension fund in Africa. We have assets of 120 billion US dollars. We have 1.2 million active members, so similar to the Ugandan fund, we have a fairly young membership. We only have about 375,000 pensioners and beneficiaries. Our fund is a defined benefit fund, and the composition of the governance of the board is that we have a board of trustees which has representation from labor. It's got representation from the employer, as well as a pensioner, as well as special forces within South Africa. I want to make a correction. Somebody mentioned that the Public Investment Corporation was a sovereign wealth fund. It isn't. It is Public Investment Corporation is an asset manager which manages assets on behalf of the GEPF. So the GEPF, with its governance structures of being a pension fund, is obviously not a sovereign wealth fund. What it does mean, though, given the size of our fund in the market in which we operate, we make up about a third of the country's GDP. We understand our role as a pension fund there, and so we do play a significant role. What it also means is that we're pretty much invested in everything in South Africa. And so in terms of our asset allocation, up until 2007, we were 100% invested in South Africa. We started investing in infrastructure in Africa opportunistically from about 2007. A portfolio manager came to the board and suggested that we invest in Pan-African infrastructure development, and that fund came about. I think the formalized structure, where we got approval from the minister to obviously increase our allocation outside the borders of South Africa, happened in 2010, where we were allowed to now invest 5% in the rest of the continent outside of South Africa, and then another 5% in global markets. The way in which we've done this is, in global market, it's very easy to gain access, and I think at the time, we really just wanted to gain access to those markets. It was, I think back in 2010, we did it into a passive fund, both in equities as well as in bonds. And at the time, the exchange rate was very favorable. It was about a R6.85 to the rand. Now it's sitting at about 13.30. That was in 5 years. And so we've just made gains in that area simply from the currency depreciation on our part, because it's pretty much a passive portfolio. On the African continent, we've had investments mostly in through infrastructure as well as private equity. I think the best way to gain that access, given the size of our fund as well as the size of the African continent market, is that we would be too large perhaps for some of the listed companies because of the small nature of those of the rest of the listed markets outside of South Africa. We're already large holders of the biggest companies in South Africa. We are holders of 10% or 13 to 15% of the top 40 stocks in South Africa. And so from a diversification point of view, it makes sense that we would go into the rest of the continent. We've done so, and we've done so mostly using infrastructure type funds, which are designed like a private equity structure with an LPGP type structure. We've also gone into infrastructure in South Africa through the capital markets, where, for example, we're large holders of the Eskom bonds, the bonds which are issued by our power utility company Eskom. We are large holders of bonds in Transnet, for example, which is the port and rail operator in South Africa. We have a lot of bond issuances. We hold a lot of bonds which are issued by SANRAL, which is the road authority in South Africa. And so given the size of our fund and the available universe to invest in, we are large holders of a lot of infrastructure as well as listed companies as well as unlisted investments. And so that pretty much, I mean, in South Africa, I would say the market is fairly regulated. The domestic market is probably very liquid on the listed equity side, and so we can move in and out of there. We try not to do too much movement. We mostly hold passive holdings. We do have a component which is active, but we obviously move the market when we make too big moves, and so we're conscious of that. I mean, I've spoken a little bit about our investment in South Africa, I think the infrastructure investments. If I want to move on then to the rest of the continent and how we kind of started with this investments, Pan-African Investment Development Fund at the time, was that we were invested in that fund, which has made investments in power utility in Kenya. We've made investments in airports, South African airport, Lanseria, as well as the airport in Tunisia. Mostly in South Africa, a lot of the investments we have are brownfield, but we're starting to see a lot more greenfield investments in the new renewable space, in new hospitals, as well as affordable housing or student accommodation in those areas. And furthermore, in infrastructure, we do have, for example, investments in undersea cabling in West Africa, as well as a couple of others in the rest of the continent. And how we've gone about this is most of our investments have been done through the Private Investment Corporation, as well as investing through private equity type and infrastructure funds. I think I'll stop there for now.
Yep, that's fantastic. So, you know, a big animal trying to diversify, but in a market that's liquid and looking at opportunities outside. So let's look at what's happening in Swaziland, Cleopas, which is not too far from South Africa, I believe.
Thank you. I'm Cleopas Lamini, the CEO of the Public Service Pension Fund, which is a government fund in Swaziland. Like in most developing countries or most African countries, the government is the single largest employer, and therefore the fund has 1.5 billion US dollars, which is easily the largest pool of funds in the Swaziland economy. The fund is invested, it's allowed to invest within Swaziland up to a minimum of 30%, and within the common monetary area of Southern Africa, which includes Swaziland, South Africa, both Lesotho and Namibia, and at the 70%, and you can, or 50%, I can say. And we have then the ability to invest 20% in overseas market. The fund is a direct, what can I call it? Is a defined benefit scheme It has a membership of 35,000, that is active members, 7,500 persons, which are pensioners. Yeah, we invest, our investments really are primarily within the Swaziland economy in unlisted securities. We do not have practically an active stock exchange, so the investments there are mainly in unlisted securities. They are in government bonds, infrastructure, real estate, private domestic equity. In infrastructure, the main areas of investment are agricultural infrastructure. We make advances to the sugar industry for the expansion of the opening up of sugar fields, expansion of sugar mills. We are also investing in the agricultural area where we are putting agricultural infrastructure for the expansion of a dairy product, for increasing the supply of milk within the economy tremendously, to a point where Parmalat is going to go into a processing of milk and milk products. The government pension fund is, the board consists of 50% members who are appointed by the government with the employer, and the other 50% are elected by the members. In the outside, the fund is not allowed to invest in unlisted equities outside of Swaziland. So basically, if we have to invest outside of the country, it has to be in listed securities. Most of our funds in the South African market are listed in invested in the Johannesburg Stock Exchange. We utilize the services of investment managers within the South African market. We also utilize investment managers in international markets who we appoint. The fund is also invested in electricity, hydro power, etc. within the Swaziland economy. The requirement basically for us to go abroad would require that the securities or the investments into which we go either are listed, or it's somehow they have a joint, they must have cross-border benefit. We are currently in a joint venture arrangement with South Africa, construction of a railway line that is starting from the eastern part of South Africa. It goes to Swaziland and it goes through again down to the port in the South African market. That railway line is going to service mining coal in the South African economy, but also within the Swaziland economy, it is going to service agriculture, mainly sugar, as well as forestry product. I think for now, maybe that is what I can say about the pension fund in Swaziland.
Thank you so much, Cleopas. Again, dominant in your market. Don't have a stock exchange, but certainly invests within the South African region in terms of the stock exchange, but mostly in agriculture on the private equity side. I believe that on the next round, let's talk about the opportunities for institutional investors. But before we do that, let's talk about Botswana. So, Lesedi, sorry. So can you
Lesedi.
just, Lesedi, yeah.
Oh, you can just say light.
Light, okay.
Yes.
Light, that's what it means, right?
Yes.
Okay, so
Or
light, go for
somebody
it.
that brightens people's lives. Huh?
Yes. Brighten my life. Give it to me.
Yeah, it was a bit tense. Okay, thank you, Africa Investor, for inviting the Botswana Public Officers Pension Fund one more time to this opportunity. As the pension fund, we are excited to come and share our stories insofar as who we are, our governance, our investment strategy is something that we talked about last year. For the past 2 years, we've been talking about this, and therefore, as investors, you really like to see what is the impact of this investment strategy. and how does it fit into your requirements. And I'll also talk about the allocations for Africa and how we see the BPOPF positioning itself into the product mix. And I'll share the opportunities, obviously, for Africa. And investors, there's a question that came from Japan. I think I'll also talk to institutional investors from outside Africa, focusing in Botswana. I think, like we've said before, the Botswana Public Officers Pension Fund is a DC fund. We were incepted in 2001. If you look at the map of Africa, Botswana is in terms of the size of the country, it's big. But population-wise, we are 1.9 million. And therefore, we would obviously not compare with South Africa and Swaziland by way of population, but we'll beat them one way or the other. We've got assets under management at the BPOPF of, we've grown from 2001, we were 1.9 billion, and currently as at the 30th of March, we are 56 billion. So relatively, like I'm saying, in relation to the population, the GDP speaks for itself. Very safe country, you must visit. The geographical, the asset allocation is that our policy is that we are invested, 40% is invested locally in Botswana, and 60% is invested offshore. I'll talk to the board. It's more or less the same like our neighbors, where we've got members from the employer side. It's a tripartite setup, where we've got membership from the employer side. We've got board membership from the unions, and we've got a pensioner trustee as well as an independent trustee, so that they can give us an independent advice on our investment strategy. We talked about the investment strategy last year. Our investment strategy from the BPOPF is reviewed every 3 years. We've got an IPS policy which is available on our website. You can come and see for yourself. But obviously, as part of governance from the regulator, is that on an annual basis, we submit our performance of the investment strategy in terms of its relevance to the market and how it is actually performing for the members themselves. So that's what we do on an annual basis. And the report, the performance, the report of the investment performance is available also on our website, so that institutional investors can see for themselves. I'll talk about the 2014-2016 investment strategy, which really focused on new objectives, new themes, and also touched on new products. It focused on the Botswana economy in the sense that we have a specific country fund for private equity and infrastructure. And also it focused on the member. We have introduced new products into the mix to cater for different life stages of the members. Firstly, for members that are in the accumulation phase, we've introduced what we call an active and deferred pensioner portfolio. It's currently online. And secondly, for members that are on the conservation phase, we have introduced what we call a pre-retirement switch portfolio. Remember, these are members that are actually nearing a retirement phase, and therefore their needs and aspirations are different from somebody that is maybe starting employment. And then lastly, members that are on the drawdown phase, we have introduced what we call a pensioner portfolio. And these different portfolios, they've got different strategies going forward. And also, the investment strategy that we are talking about here, which is currently, it's fully implemented, it's diversified. It has introduced new products like the South African inflation-linked bonds. We've got international property and bonds. I hope it is clear. But going forward, what does this mean to the institutional investor like my friend from Japan? Is that we have allocated 15% for the emerging market allocation, which includes Africa. But because of the different needs and aspirations and the requirements from the markets, is that we are currently reviewing and at an infantry stage of the 2016-2019 investment strategy. Remember that I said every 3 years we do revise. And therefore, going forward is that we are going to have a specific allocation for Africa. That 15% that I talked about is inclusive of your emerging markets, your Brazils and things like that. But now, going forward, we are going to refine ourselves and have a specific allocation for Africa. And that is something that we are excited about, and we see ourselves playing a pivotal investment forum or impact into Africa going forward. What are the tenders and what are the opportunities that lie ahead for my Japanese friend out there? As the BPOPF, we've run out a lot of tenders and we've appointed managers both locally and offshore. But currently what we are doing is that we have run a tender for 500 million for infrastructure, and that includes sub-Saharan as well. And also there's 300 million tender that is available for the private equity. It's available on the website. So investors, look out to www.bpopf.co.w. We would like to partner with yourselves. Thank you.
Well, Light has shed a lot of light on the innovations that are happening. Certainly, you know, a lot of interesting stuff going on in Botswana. So let's finally nail it with Dave from Nigeria. So let's tell us what's happening with the pension sector in Nigeria, the reforms that are happening there as well. And if you could just share a little bit what's happening in terms of the whole regulation as well, because, you know, initially, as you know, we were supposed to get a regulator, but I would like you to just talk about some of the regulations as well.
Okay, thank you very much. So I'll talk about the Nigerian pension markets, the reforms, where we are. I'll talk about some of the regulatory issues and the outlook. I will also talk about the African Pension Fund Network. So Nigerian pension market is largely a defined contribution market, started about 10 years ago, 2004. It's completely privatized. There are no government funds in Nigeria, so that's the first point to note. There are 27 managers. They are all private sector companies. So in a sense, they operate like banks, or they operate like asset managers, but with a focus on pensions. They are SPVs. They can't do any other thing but manage pension funds. So one of the challenges in the local markets is that you see the pension funds are crowding out other asset managers. So currently we have $25 billion under management in the industry. That number is a lot bigger in local currency, but we've had devaluation challenges. It's like, say, 27 managers. The market's growing at between 25 and 30% per annum. In terms of the contribution rate, it's 18% of salaries. It's mandatory for all employees to have pension account in Nigeria. Any company that has working population of 5 staff must have pension scheme for them. So, and it's criminal not to do so. In terms of we are 7 million contributors out of a working population of 70 million. So it's very small, early stage market, 10% penetration rates. In terms of the assets under management as a percentage of GDP is about 5%. So relative to South Africa, which is about 70%. So essentially, it's an early stage market. It's just growing. The contributors are very young, about 70% below the age of 40, and you know, the fund is tracking very well. In terms of asset allocation, it's currently 100% invested in Nigeria. So that's a bit of a shame for more international fund managers, because the whole idea and the thinking of government and regulators is that there are incredible opportunities in Nigeria, huge challenges, funding deficits across all sectors, housing, infrastructure, private equity, you know, companies, SMEs. So, you know, so the idea is to, you know, keep most of these monies locally. Currently, 70% of that money is invested in government bonds, 13% in listed equities, 5% in real estate, and 20% in money market securities of banks. So the government bond market is the deepest market in Nigeria. It's very deep secondary markets. Issuance levels are very high, and like I think one of the speakers said on the panel, it gives you real rate of return, positive real rate of return, even adjusting for currency devaluation. So it's a very good, it's an attractive instrument for pension funds. However, there's been a lot of talk about diversifying these monies. And what you find is that when pension market starts, they usually start with government bonds because they're usually the safest, and one of the primary consideration for pensions is safety of the funds and ability to meet financing, to finance the annuities when they are due. In terms of where we see reforms going and the challenge, one of the key challenges is the dearth of instruments in the local markets. The reason why the pension funds are not invested or investing in things like alternatives and private equity range from regulation. So the regulation, like I said, means that we can only invest in instruments in Nigeria. We're allowed to invest in practically everything: infrastructure bonds, infrastructure funds, private equity, housing, but they must be launched and managed by Nigerian registered companies. And they, for PE and infrastructure, 70%, 75% of the funds raised must be invested in Nigeria. 25% can be invested in anywhere. So that's one of the challenges. There's a dearth of domestic fund managers. There's also, a dearth of skills in pension industry in being able to analyze these instruments, and so that's where the market is going. However, there are regulatory reforms being carried out to open up the market. One of the things that the government is doing, or the regulator, is to introduce a multi-fund regime, which allows members to choose from 3 up to 4 funds, depending on how old they are. And the first fund, which is for the youngest members, can invest up to 60% in equities, including private equity, infrastructure, any asset class that has, the risk is not, that is not fixed income. And we see that as opening up the market. The other point and the other regulatory future is the minimum 5% allocation to alternative investments, which the government is trying to use to force pension fund managers to invest in, infrastructure and private equity and housing. There's also the need to improve access to infrastructure. I mean, the huge infrastructure deficit in Nigeria, financing deficits, means that government is looking for ways to do that. There are challenges currently because most of the infrastructure in Nigeria are greenfield assets, and pension funds typically don't invest in those sort of assets because of the risk levels. So the government is trying to encourage working with the sovereign wealth fund to issue guarantees either from government or other entities to mitigate the risk of investing in infrastructure. Like I said, there are 7 million contributors. All of them are in the formal sector. There's no informal sector pension in Nigeria. So one of the things that regulators is doing is to open up the informal sector using things like mobile money platform, working with banks and telcos to improve collection, because 80% of the working population in Nigeria in the formal sector, if you come to Lagos, a huge market. In the market, they sell, anybody that's come to Lagos, you can't but go to, there's a market behind my office, I think yesterday. When the women come, they always stop by there to buy things. It's very huge market, but it's completely informal. Transactions there runs into billions of naira every day, but completely informal. That's the market that government is trying to open up. The other thing is investment in housing. There's been, the government last year formed the Nigerian Mortgage Refinancing Corporation to open up mortgage financing in Nigeria, and the pension funds. They recently issued a bond which some of the pension funds invested in, and the proceeds will be used to provide a secondary market for mortgages in the country. So that's where we are with the Nigerian pension markets. I'll just end with the African Pension Fund Network. So what we realized was that some of the challenges I've mentioned cut across most countries in Africa. So working with African Development Bank, making finance work for Africa, which is the initiative of the G8. Last year, we formed the African Pension Fund Network in Dakar, Senegal. during one of the AFDB's meetings. What we realized that about $350 billion of pension funds in Africa, largely from South Africa, Nigeria, Botswana, East Africa, Namibia, and most of these funds are invested in government bonds except South Africa. So we realized that the problem in Africa is not necessarily the funds, but it's the structures to allow the funds to go into the real sector. And we also think that the big deal in Africa is really the pension funds, not the sovereign wealth funds, because sovereign wealth funds are very small. In Nigeria, sovereign wealth fund is less than $2 billion. In South Africa, I don't think they really have a sovereign wealth fund because, like Fuller has just mentioned, the PIC is not a sovereign wealth fund. So in Africa, the big deal is the pension funds. From the growth rate that I've just told you, in 2025, there'll be about $1 trillion of pension funds in Africa. And pension reforms are happening everywhere. They're opening up, Uganda, Ghana, everywhere. It's happening everywhere, So we think that, so we decided to form this network to serve as a voice for pension on the continent, to lobby and form as advocacy with government and regulators to open up the investment market, particularly cross-border investments. There's huge opportunities for cross-border investments. Infrastructure investments are huge, and most African pension funds are small, if you're excluding the GEPF. So we think that they could work together to co-invest in projects across the continent. We also want to encourage regulators to completely remove all the restrictions that inhibit investments in other African countries. Yesterday, I was speaking to the CEO of Equity Bank, and he said to me, look, my friend, you missed out because the PE guys that invested in Equity Bank, they made 463% return in US dollars in 5 years. And these are some of the sort of investment that we cannot do from Nigeria. So we think that working with the African Pension Fund Network and all the big pension funds in Africa, we can remove those restrictions and open up the market to financing by pension funds in Africa. Thank you.
Dave, you've done really, really well because you've actually answered my next question, which is what's the reforms that are currently taking place and how is that affecting the improvements within the sector. So I think Dave, having covered really what's happening within the network, which covers many of the pensions, I would like now to bring it back to the floor and see if there are any questions, and then we'll sort of summarize after that. So if you could get a couple of questions from the floor. And by the way, lunch is calling.
So
just an added incentive to keep the questions not complicated.
Mine is not really a question, it's more a clarification. I thanks the panel for the amazing job, and as well for giving me the opportunity to clarify what I said before, as it's mentioned twice. In the number several fund I mentioned, the 4 under consideration consider South African upcoming sovereign wealth fund.
Okay.
I also mentioned that there is a source named ONFIF that consider PAC as a sovereign wealth funds. So during our conversation in the panel, we used the consideration that according to our panel, PAC is not a sovereign wealth funds. But it was for the sake of the reasoning and the objectiveness of the fact that changing definition, unfortunately, changed the overview. Not only in terms of is a sovereign funds or not, but the overall asset under management of sovereign wealth funds, because under $50 billion is more or less what PIC is.
Yeah.
And I do agree 100% that PIC doesn't have any requirement, but if we change definition, according to HomeFifth, it should be included. So thank you for the clarification.
Not a problem. We'll send you the bill for that. Let's have another question.
Thank you. Rob Colorina with AIC Investment. Maybe this is towards Fulu or whoever wants to comment. The transition from being South Africa only, and we've invested in Africa, including South Africa, towards multiple countries within Africa. Can you speak a little bit about the thinking behind that, change between the operating people and your board, and maybe just some of the surprises that came that could be positive or negative towards that expansion?
I think, Fuller, that's for you.
Okay. Happy to take it. So the change happened, so the liabilities of, obviously, South African pension funds are based in South Africa. And so, being a government fund as well, you want to create employment and you want to create all the great things in your home country, but you also realize that you need diversification. And so it was an engagement process between the Board of Trustees at the time with the Minister of Finance to say, well, is it possible that we could at least start with maybe just Africa? And we realize that the opportunities are great and they're there, but given the size of our fund and the size of the market, we're just not going to gain any traction quickly enough. And so if we do want to diversify further, we said we'd go into global markets. So the tenure of trustees is also an issue. So whilst there's the long-term investments, it's a defined benefit fund, it's got long-term liabilities. You've got infrastructure investments, which are long-term in nature with a predictable cash flow. You want to be invested in a lot of those. I think the difficulty we have is in the tenure of the trustees, in the sense that they have a 4 to 5 year term, and sometimes decisions made by that board obviously impact the decisions of the next board, and so you do find that it's a difficulty sometimes in having to explain why you went into some investment in some country for whatever the reason was at the time. What we do find in general is that there is some overlap in the board of trustees, and so you may find that a trustee member is elected and stays on for 2 terms. And so that allows for that kind of transition phase and for continuity within the board. And so we've recently, well, not recently, about 1.5 years ago, a new board came in and has continued the strategy of the previous board. We're at a point where we're reviewing our asset liability modeling at this point in time. And so it may be that we go through an engagement phase again with the minister to say, could we further diversify? I think what we are seeing in terms of opportunities is that the African continent offers a lot of that diversification for us. Yes, global markets do too, but I think in terms of our role in South Africa and in Africa, we prefer to be going into those markets. We also find that the returns we're expecting, so I've spoke pretty much about everything else except I haven't spoken about returns. So we have had really great returns in South Africa as well as in the African continent. We've also seen that a lot of South African listed companies have expansion programs into the rest of the continent. And so through our holdings in a lot of South African companies, we have exposure to the rest of the continent. And so from a return perspective, I mean, I don't know if you've seen the numbers on the Johannesburg Stock Exchange, but it's been phenomenal. We've seen double-digit returns for over 5 years. We've seen returns over 20% in the last couple of years. We don't think that is sustainable, but we certainly have seen that. And so as a way forward, we need to diversify away from those listed markets into the kind of unlisted markets. We will get that diversification. And we believe that in South Africa, we're still seeing, whilst, for example, infrastructure returns have lowered somewhat, we certainly do think that in the rest of the continent, the return profile is certainly higher. And more diversified for our portfolio.
Yep. Any more questions? I think there's one more there.
Yes, I had a question. I'm Hugh Bobbitt from Georgetown Equity Advisors. I was representing a hedge fund in Switzerland, and we approached your fund because of some of the currency issues and through some contacts that I have in South Africa, former chairman of Eskom Pension Fund, and it was, we were not able to really get anywhere, and as we can see on the continent, one thing that's needed, I think, is currency management of some of the currencies and some of the funds and some of the pension funds.
Well, would you like to take that? I think it is a general question. I think the rest of my colleagues, I know the currencies have really suffered, but if you want specifically from the South African perspective, perhaps she can answer.
Yeah, sure. I mean, so from a hedge fund perspective, or rather hedge funds you said you represented a hedge fund in, yeah. So when we decided to go on our international allocation, we decided to access the market in the best way possible, the quickest way to gain that exposure. And also given the capacity and the resources within our institutions, between the GPF and the PIC, we kind of started with the fruit, like picking the low-hanging fruit. And so for us, that was investing in passive management and having obviously that diversification in the currencies through investing in those, for example, emerging market currencies, which are or emerging market companies which are listed, let's say, on the MSCI, within the MSCI is 15%. It's a MSCI all country, which is 15% emerging markets. And so we do have that exposure. And the rest of it is obviously local currency African investments, which we do have. The way that we've done it is that we've invested in the local currency with no with no hedging of those underlying currencies at the time. So we do take the currency exposure.
Currency risk, okay. Great.
Currency risk.
Is it Raj?
Mahesh Kotaj, may I push a little further on this issue, because I think it's quite, as a speaker pointed out, it's quite vital, and I'd like to kind of make this particular point. If you look at let's say 54 countries in Africa, or 36 countries in sub-Saharan Africa or Middle Africa, if you
and
know,
54 currencies, I suppose.
54 currencies, right? Now each one has 80%, 70%, even maybe 60% or 40% in their own countries, right? So you have huge amount of exposure to yourself. But as a whole, you could pool through the network and create a fund which is something everybody can participate in. It seems to me this is your low-hanging fruit that somebody should pluck, because you could create an Africa-wide pension fund in which everyone can participate to a larger or a smaller degree.
Yeah.
Why not do that?
Yeah,
I think that's what the network is about.
Yes.
Well, actually, Dev, you can fill that in. You got all the answers.
That's it. Well, I'm not sure about that. That's a very good point. I think that's one of the things that the network is all about. But you realize that you have a mix of government funds, private sector funds, and all of that, and decision-making process vary from fund to fund, from company to company. Some of them need boards and presidential approval to do things. So we're trying to navigate all of that. The thinking and the big theme is really around vehicles that will allow pension funds to access, to access real assets on the continent. So whether it's infrastructure, private equity, and housing, but particularly on infrastructure. I think that's a big theme, and I think that it's, I can't say that it's one year or 2 years away, but I think that is the whole objective of the network, and it's something that African Development Bank is really, really interested in doing. So we can have discussions around that after our panel, if anyone is interested in that.
Yeah.
I think maybe, Mr. Chairman,
sorry,
just maybe to add to this, to the panel, is that I think we also, as Africa, need to look at the issue of institutional memory. My colleague just talked about the issue of board turnover. Yes. It's an issue that is not only prevalent or maybe unique to South Africa. I think in almost all the pension funds, it's an issue that we really, at that forum, we also need to maybe lobby as to having a fixed term for the board of trustees, so that there's one thing that we also have to be mindful of, the fact that as a pension fund, you exist for one reason, and that reason is to have your members having a dignified life after retirement. And now, if the board of trustees maybe come for maybe 6 months, and after 6 months they would have done maybe an introduction of their investment strategy, and then they leave it midway, and then somebody comes, people have got different ways of doing things. And therefore, this issue of the institutional memory is something that your forum should really be looking at, lobbying for the different pension funds through the regulators. Thank you.
Yeah. All right, maybe one more before we come back to the panel. Well, it looks like we won't have one more, so we'll come back to the panel. So just as closing remarks, I'd like each one of you to pick on to what you think will happen over the next 3 to 5 years, certainly with an emphasis on opportunity to especially the investors out here who are not in Africa. So if we'd start off this time with Dev and go down the line.
Okay, so I think for me the big theme is really on infrastructure investments in Africa and how to get it right, how pension funds can invest in infrastructure, and we think that so like we made the point, most of investment opportunities in Africa infrastructure are greenfield rather than brownfield assets, and you could say not so suitable for pension funds to get in. But how do we overcome these challenges? We also think that the private equity model of 2 and 20 won't work with this greenfield asset because, you start a toll road and, it takes 5 years to complete. You are paying 2% to the asset manager. At the end of the day, you're probably losing out. So one of the things we're trying to lobby government to do is to set up a fund with our sovereign wealth fund and perhaps also open it up to other pension funds that already have the allocation to Africa, like South Africa and Botswana, to buy brownfield assets from governments. So you have airports, you have toll roads, you have power plants that have been built and been de-risked and are operating and commercially viable. We think that the pension funds can buy these assets and release monies to government to go and build the next generation of greenfield assets. So we think that if you use this mechanism, you could create a platform where, so if you buy those assets, maybe $5 billion, you give government, they go and build the next set of assets, and then you turn around and buy them because ultimately the pension funds are the real, long-term holders of this asset because our members are young and we can hold them for forever, 30 years, 40 years. So that for me is the big theme, as far as pensions is concerned.
Yep, let's see there.
Yes, thank you. I think for Botswana, like I said before, our going forward as a strategy is on the infrastructure, but the thing that gives us sleepless nights is how do we ensure that the identified projects for the infrastructure gives us back return in the shortest period of time. So in terms of the next 2 to 3 years, is that we need to segment our projects so that we can start with those 1 to maybe 12 months projects, so that at the end of the day, by the time we declare our interest or our returns to the board or to the members, we ought to have a continuity into the sphere. Thank you.
Thank you. Cleopas.
Thank you. I think the last part, one speaker actually hit the nail on the head. Pension funds, as we know, manage financial assets. They don't manage projects. So we need to form instruments, structure them in such a way that they can be specific to projects, they can be specific to sectors. But given the size of the pension funds that we have in most African countries, it is simply attractive to invest in instruments that are specifically designed rather than to look into projects, especially if the projects are cross-border, because then you don't understand the setup. I don't understand the setup in Mozambique, which is very close to Swaziland. So how much more in Gabon and other countries? So I would really say we form these instruments and then they trade within the regions. Thank you.
And Falu?
Yeah. So, I mean, I've indicated that ours is not a very diversified, well, we're trying to find further diversification. And so what we are doing is obviously moving some of our listed assets into unlisted. I go back to the point that has been made. At the end of the day, the role of our existence is to pay pensions. And so we have to look at the risk that we're taking relative to the return we're expecting for each of these asset classes. And so given where we are, we do have some direct real estate, we do have some listed equities, some listed bonds and so forth. For us, the thing that's going to pay is probably further diversification of our portfolio. So I indicated that we've got 5% targeted for Africa when it's not invested. It's only 1.5% invested. Our fund is also a young fund, it's a growing fund, we're 100% funded, and so this target is always a moving target. And so we're basically looking to find opportunities, and we believe that these will be found in the unlisted sectors, so that's real estate, that is infrastructure, that is private equity, mezzanine funding, and obviously the growing listed markets within the rest of the African continent.
Well, thank you so much. I'd like to end by actually quoting from the newspaper headline that ran in my country today. And it went along, I left my phone there, but it went along the lines, NSSF, which is the pension fund in Uganda, which I manage. NSSF doesn't have, has more money than opportunities. Where can we find the opportunities? I believe that there is a lot of opportunities around the continent. And I believe that many of the pension funds are in this position where they can't manage projects, but they need to manage financial assets that will basically be able then to add value to Africa. And we think that the opportunity exists in the sense that the regulation is changing, that the capital markets are improving, and there is a lot of work to be done. So thank you so much for listening to us.
Doing business in Africa. You can't afford to be without Africa Investor.